Jindal Steel delivered its Q1 numbers and it's not been a bad set, but we have seen its margins, its EBITDA cool off from those record high levels that it was posting them at on a quarterly basis in the last few quarters, Q3, Q4, so record EBITDA. But in Q1, costs have played a dampener. We have seen a rise in coking coal, particularly quite a bit of a rise in iron ore prices as well. In fact, we spoke with VR Sharma of Jindal Steel, and he says that this is for the first time in many decades that we actually have seen iron ore and coking coal prices trade at the same level of $220 and $250 per ton roughly. Though, of course, mind you, iron ore has cooled off quite a bit, but coking coal continues to stay higher. Now, that's really the concern, because remember, Jindal Steel does not really have captive mines. In this high cost environment, how do you deal with costs staying elevated? The other point is that steel prices have come off a little bit due to seasonality. Mr. Sharma says that we are also seeing a slowdown in construction. So that is an added point. However, going forward, there are two pointers which Mr. Sharma said, because of which we can heave a sigh of relief. Firstly, he's saying that construction activity will come back on track, workers will come back onto their sites, and that in turn will lead to a recovery in steel demand. The other trigger for a recovery in steel prices could be that, or rather the reason why steel prices were down was because iron ore prices as well have softened. So where iron ore was at $220 or dollars per ton at its peak, now it's at $160 per ton. So that as well is sort of a pull factor, though mind you, coking coal prices are still extremely high at $220 or dollars per ton. But nevertheless, the fact that iron ore has come off, that is a factor of relief. But what about JSPL's margins then? Well, at this point of time, he's saying that JSPL will be able to maintain their EBITDA margins at roughly about 20,000 rupees per ton. In terms of procurement of iron ore, a very important event took place, during the quarter. By mid-April, JSPL had actually exhausted their Sarda mines. This was low-cost inventory of iron ore that was lying at the Sarda pit heads. Now that's been exhausted. So Mr. Sharma said that they are procuring iron ore from NMDC and from OMC. And, given the fact that the states of Odisha and Chhattisgarh are now considering prioritizing those plants which are located in those states, there should not be any concern with respect to consistent supply and availability of iron ore to service the steel plants. On the balance sheet front, of course, we're watching out for that JPL divestment, which Mr. Sharma says will make JSPL's balance sheet healthier. Overall, the net debt to EBITDA has been under 1. It will continue to stay. In fact, it will go even lower post the divestment. Another 3,000 to 4,000 crores of debt as well will be paid down over the next few quarters. So that too will further help bringing down the net debt. He's also, by the way, said that they have a net debt target for JSPL of 8,000 crore rupees. So that is something as well pretty noteworthy.